Lowe stock is down about 25% at recent prices. Home Depot shares are down even more, closer to 30%. If you're interested in buying either company today, it's not a bad idea, especially if you're an income-focused dividend investor. After all, these are really strong companies, right? You think about what's going on with the housing market cycle. There's a good chance that they're both going to prove far more resistant to that downturn and very resilient businesses, maybe than the market expects. However, don't be so quick to pull the trigger just yet, especially if you're looking to take advantage of the sell-off over the long term and you want to boost your returns. I'm Jason Hall. This is The Smattering, and I want to make the case for a smaller, more specialized company in home improvement that I think might be a better investment to juice your returns and get bigger gains. But before we do that, I just want to thank our friends over at The Motley Fool. We get to make these videos because of our great partnership with The Fool. If you want to get some great investment ideas, if you want to become a better stock picker, go to our link, fool.com/The Smattering. Put in some information. The Fool is going to share their 10 top stocks to buy right now. Check that out. Thanks. Okay, let's talk about what's going on here and why Trex, I think, might be worth a closer look if you're looking to really juice your returns, even better than maybe Lowe's or Home Depot. All right, I'm going to share some more charts here. So this is a chart from our friends over at Y Charts. This is a look at what's happened so far, or over the past year, really. If you look at Trex's stock, it's at the purple line there. It's absolutely been smashed. It's down 68%. You look at Home Depot and Lowe's, they're down 26 and 29% compared to the S&P 500, down a little bit less than 20% at this point. Here's the bottom line. I'm going to say it again. Home Depot and Lowe's, I feel like if you bought them at these levels, you're going to do well. You're going to be happy if you hold 3, 5+ years. And again, especially if you're a dividend investor, those yields have been pushed up because the stock price has come down, and it does make them compelling. But I'm telling you, there's a case for Trex, and I'm going to share it starting with this. This is Trex's returns over the past decade. It's absolutely crushed the market, and it's done better than Home Depot and Lowe's, which have been amazing investments over this period of time. So that 1,000% in returns, what does that mean? If you invested $1,000 in Trex on Halloween Day in 2012, you'd have $11,000 right now, even after this major sell-off that we've seen over the past year. That's how wonderful Trex's business has been over that period. All right, so that's great. That's what it's done, right? As an investor, it's like, okay, what's it going to do going forward? And I think to make the case for that, we need to talk about what's happened, why the stock has sold off, what's going on with the business. So Trex just reported third quarter results here, and I'm going to talk a little bit about some numbers. We're going to share from their 10Q, and this is operating results right here. So we're going to start, I'm actually going to back up, and I'm going to start right here with their net sales results. We need to start and look at net sales, and you see right here, okay, these two columns here, this is the quarter, $188.5 million in net sales. That's compared to $336 million in net sales in the year-over-year period. That is a huge drop in sales. There's no getting around that. What the heck happened? Okay. The short version is activity for things, expensive projects like decks has slowed down substantially. Higher interest rates, you know, those HELOCs and other home equity loan type things to pay for it. Interest rates have gone up. It's a lot more expensive than it was even a year ago to do those things. We know that rising inflation has pushed labor costs up. Costs are higher, right? It costs a lot more to do this kind of stuff than it did a year ago. People are also worried about recession, so they're backing off. They're slowing down on spending. And what happened with Trex simply is that its distribution partners depleted their inventories and providing a product to home improvement professionals and to DIYers from their Trex product. They didn't order a ton of Trex. As a result, the business kind of fell off a cliff in the third quarter. Now, just to see for the for the first 3 quarters of the year, for the first 9 months, revenue is still ahead of where it was a year ago. And we're going to talk about guidance for the full year here in just a second. And I think there's some positive things to see. But here's the thing that happened. Income fell sharply, but Trex is still profitable. $14.4 million in net income. That fell substantially from about $74 million in net income a year ago. And net income for the full year, the first 3 quarters of the year so far, is down, right? What's going on? Short version, Trex is having to lay off workers. They're having to cut back on their staff because they know production is going to be down a little bit. There's some realities that they're having to deal with. Now, here's the thing that is positive about that. It's not great when any company that's in a cyclical business says, okay, we're having to cut back on our staff. They had some pretty big expenses tied to severance costs in the quarter, but they're committed to being ready when the cycle turns. They've been through this before. Management said, we're keeping our most tenured, our highest performance production staff because we want to be ready when the market does turn, that we can quickly regain that production that we need to add back to meet that future demand. So I think that's a positive. Again, it's a reminder that this is a tenured staff, management staff. They've been through this kind of thing. They've been through this kind of thing before. Now, I'm going to share a slide, just a page here from the press release. And this is the section for the company's outlook for the coming quarter and for the rest of the year. And this is important. They reaffirmed their guidance for net sales between $180 and $190 million in the fourth quarter. And they held firm on their expectation for full year EBITDA margins, 28% at the midpoint, and fourth quarter EBITDA margins of about 23, 24% at the midpoint. That's a positive because the company, they know what's going on. They talk to their distributors. They understand the pressures and the cycles, and they're saying that their buyers, that they sell to, which are the distributors and the Home Depots and Lowe's of the world, they're still basically going to spend the same money that they had been expecting to spend when the company made its guidance at the beginning of the year. So that's a real positive for the company over the long term. Now, I want to make another case here about the bigger trend, the secular opportunities here. And we're going to look at a couple slides from the September company presentation. This is the first one here. The decking and railing market, this is where the company participates today. This is an $8 billion market. This is a substantial opportunity for a company that does about $1 billion in revenue right now. So its ability to continue to take market share, continue to expand is there. This is a business that also has some optionality. They're looking to expand into the cladding market. You see in the image right here, the Trex product can work really well to replace wood cladding in commercial construction and in residential construction. So they're always looking for ways to have optionality. And I think this is one that really leverages their core strengths. I want to share this one last. Again, this talks about taking market share. You look at Trex, you go back 4 or 5 years ago, this is a company that had maybe 6 or 7% of the wood decking market. Now that's 25% number here. That's Trex and all of its competitors, the entire market. Now Trex has 12 or 13% of the entire market. It has a long history of taking market share, growing that market share, and really driving composite, continually taking more and more market share from wood. So put it all together, and what do you have? You have a pure play, you have a specialist. That's why Trex's stock has been down far more than Home Depot and Lowe's. It also means the stock's probably going to be far more volatile. As we see its main product selling that wood alternative decking, that composite decking, it's its biggest business. It's not like Home Depot or Lowe's where people are still coming in and buying cleaning materials and your dryer breaks and you go buy a new dryer. And you also have all of those discretionary spends for remodeling. And oh yeah, by the way, a slowing down housing market could mean people spending more money to update their existing house since they can't buy a bigger house or they can't find the house that they want to own. So that's important to remember as well. So you put it together, you have a strong business with the secular trends that are in its favor. And these are the opportunities we've been trained for as investors. We find those dislocations, find good companies that are beaten down more than the rest of the market during a downturn, invest, and then be patient and let management return capital for us as they grow the business. The market comes back to that stock and we profit from those gains.